on?
No, I haven't, well, I don't think he's on. I haven't heard anyone else.
So I had if it's okay, I'm gonna do a couple of housekeeping things for the trustees real quick. Should only take a minute. So today I realized after you guys came in and signed, both Charlie and Chris, that we hadn't actually completed or had everybody re-sign the signing document. So that needs to be redone, meaning that Colin, Charlie, and Chris all have to sign again. Is that right?
That's correct, yes.
Yeah. So if you guys can make it in tomorrow sometime, then it'll be in the town manager's office waiting for you. And then I'll have everything else is completed with the exception of the letter to be signed. And
Yep, so it's the authorized signers list.
Okay, and then that'll go off to you. And then Chris.
Yeah, and then also copies of your licenses as well.
Right, I was just gonna say that. I need that from Chris.
Okay.
Because she's a new person, right? Everybody else
Yep.
is they've already done all that.
Right, but we just need everyone to sign the new form. So there we have them all listed on one sheet.
Right.
How late will someone be there tomorrow?
Until I think the office technically closes at noon.
Yeah.
So if that's too late, you know what we can do is, I mean, we do wait till Monday. That's fine.
Yeah, I don't get back into Newmarket until probably 5:15, 5:30 every day.
Okay. So what I can do is I can have Terry bring it over to you, if that's all right.
Either that, or I could stop by on Wednesday. That's when I've always stopped by before, because that's the late night for them. But if she wants to run it by before that, that's fine.
Terrific. Okay. All right, that's it.
So did we decide I'm going tomorrow before noon, or did we decide I wait until Monday?
That's entirely up to you, whatever is.
Oh, okay,
most
so things
convenient.
are ready tomorrow by tomorrow before noon.
Absolutely. They'll be there by let's say 9 o'clock. Everything will be in Wendy's hands waiting for anybody to come in.
Okay, I'll come
Okay.
after that sometime, but before noon. Thank you. Sure.
All right, great. I appreciate it.
Sure.
Okay, I'll hand it over to you guys. And
Okay.
we can hear about how the investments are doing or have done this past year.
Sure. Well, it's good to see you by Zoom. Happy New Year to all of you. Hope you had a good, safe holiday. And I hope we're able to go outside and enjoy the spring down the road and stay healthy.
Thank you.
Sure. No. In terms of markets, there's been all this.
Yeah, I'm not muted, right? Oh, good, okay. Yeah.
We hear you, Tim.
Was that Tim?
Yeah.
Maybe it's Charlie.
You know, this is sort of
Looks like Timothy.
It was me. I'm off.
And I think he's checked out. Okay.
Good.
So the equity markets have been quite strong. So despite all the volatility, you know, healthcare situations and recessions and economic slowdowns and geopolitical issues and so on, the markets continue to move forward up into new highs. And basically, it's driven by one person, Jerome Powell, the Fed chairman. I mean, what I saw different acronyms that I had, and I saw an old one that came to mind today. It's TINA, T-I-N-A. There is no alternative. And so he come out and he poured all this, you know, $6-7 trillion of liquidity, as did double that from the rest of the world, into the system, kept interest rates, brought them all the way down to zero, and then told everyone that he wasn't even thinking about raising rates. And so people appreciated that they weren't going to get any return on their fixed income investments. So they went into equities, and it was almost like what was Greenspan put of years ago, where the government buys out your securities at a premium. And that's continued right up until today. And so, and in so doing, we've issued a lot of debt. And so the real question is, when your dollar gets weak, and then you're at a disadvantage in terms of financing your debt, because you have to pay more in dollars if your dollar is weaker. So far, we've been pretty strong, but even though our rates are so low, they still are pretty high in comparison to some other countries. Our 10-year is now just over 1%, but say 0.9. The British, and they've had a lot of issues with Brexit and stuff. The British 10-year is 0.25% versus ours being at 1%. And then the German 10-year bond is negative 50 basis points, or negative 0.5%. And what that means is not that you're going to pay back the money. You pay negative interest, so you get more money. It's that you're getting zero interest, but then instead of paying $100 for an investment that you'll get $100 back, you're paying like $102 for something you'll get $100 back. So you're going to lose 2%. And you say, why would somebody do that? Well, if you're a big institution or a pension plan or something, you have billions of dollars. You can't just go to the local bank and say, I'm going to put in a few $1 billion, and can you FDIC insure it for $250,000 and let's run on the rest of it. So it's safer for those organizations to put money in a sovereign place like the German government and so on. So that's one reason we have what I call negative rates. They're really negative yields to maturity. And Japan has had negative yields to maturity for the last 20 years. And they've been just trying to stimulate their economy, and they haven't been able to do it. So, so as a result, with equities, the whole story on stocks is there's different ways you can make money on a stock. You can either grow earnings, so you're making more money, more profits. You can increase the dividend, which is a couple percent return, and you can pay a higher multiple on those earnings. So if you earn $1, the stock will be $10. It's because you're paying 10 times for those earnings. Now, I use an example. If you had a building that generated $10,000 of profit, net operating income after your expenses and so on. Let's say it's a rental building, and you can go to the bank and get 10%, which of course you can't get anywhere near that. But let's say you can get 10% on a bond, on a CD. The price of the building, you'd say, well, I want to make 10% on my building because I can buy the CD risk-free. So if I'm going to buy the building, I want to make 10%. So for 10,000 of income, you'll pay 100,000 for the building. Now, so you pay 100,000 based on that 10,000 of income. Now, nothing else has changed except interest rates on that CD have gone down from 10% to 5%. So now all I can make at the bank is 5%. So now that $10,000, there was going to be a 10% return to be comparable to the 10% CD. I will accept a 5% return. So if I'm going to make 10,000 a profit, I'll pay 200,000 for the same building, because 10,000 out of 200 is 5% profit. And that's in essence what happened to the stock market. The earnings of the market have been flat. This year they're actually down because of the pandemic and so on. But they've been flat for the last 4 years at $160. But last year the market was up 31%, and this year was up another 18. In 2020, 2019 was up 31%. And the earnings have not grown. Actually, they went down this year. So that multiple that I talk about, earnings are flat, but the multiple went from 16 times to now 23 times in the market. So that whole 30% return, none of it was more profits. It was all the multiple, or how much you pay for those profits. So that's something that's dependent on the alternatives. And I just told you that there is no alternative because Powell's kept rates at zero. So I used to be a analyst at a firm in Boston. I ran a mutual fund, and my first industry was personal computers. It was IBM and Hewlett Packard and digital equipment and Wang and Data General and Compaq Computer and so on. And the whole group used to trade at 8 times earnings to 12 times earnings. You'd buy them at 8 times earnings and then you'd sell them at 12 times earnings. Now, a few months ago, the target price for Apple was based on, so this is a company that had very little profits back then, and you'd pay 8 to 12 times earnings. Now you're paying 33 times earnings. So 3 times the multiple, 3 to 4 times the multiple on those earnings because there is no alternative. So Apple's gone from $1 billion company to a $2 trillion company. And that's happened to other technology stocks. It's happened to some of the companies like Tesla's of the world don't even really have any profit. So the valuations have gotten very, very high. So on an absolute basis, they look high, but on a relative basis, because there is no alternative, I don't know if it's too high. What we're watching out for is higher inflation and a weaker dollar and the inability to roll over some of this debt. But so far, so good, and it's all because of that confidence in Chairman Powell. So, so the returns for last year, I mentioned about 18% in the equity market. Fixed income returns were mid-single digit, 5-6%. And just for comparison purposes, it's a long time ago now, but we just finished a decade. And the reason you have diversification in the portfolio and balance is because from 2000 to 2010, we had the internet bubble and then the great financial crisis in 2009. Equities in that 10-year period were down 0.9% a year, compounded down 1% a year for that whole decade, over that decade. For the teens from 2010 to 2020, 2019, the beginning of 2020, we were up 13.6%. So for people who got out in 09 because they said, forget it, the banks are all going out of business and so on, I'm out, you just was down 1% a year for 10 years and you got none of that 4 times up move. And so, but over the whole period, you were down 1% for 10 years, up 14% a year for 10 years. You were up about 7-8%, which is more or less the long-term average with a lot of volatility. During that same period, 2000 to 2010, the US core bond return was 6% from 2000 to 2010. From 2010 to 2019, it was 4%. So over the 20-year period, so very little volatility, pretty much more or less straight up, but flat and straight up because interest rates were coming down during that period. And so you averaged 5%. So you didn't do as well as you did with stocks, but you slept a lot better nights and stuff. Now, with interest rates down as low as they are, you're less likely to make much more than the coupon on a bond. So when coupons are so low that they were, like I said, the 2-year bond is only 10 basis points, so 0.1%. So the only way you'll make more than 0.1% if you buy a 2-year bond is if rates go down from 0.1, and it's not so far they can go down unless they go negative. But if they go down from 0.1, you'll make a little bit more than 0.1%. You'll make a little bit more. Last year, this time, the 2-year bond was at 1.5%. So you made 1.5, and then rates came down. So your 2% piece of paper was very attractive to somebody else who was going to the bond market and getting 0.2% or 0.1%. So what opportunity did you have? You have your 1.5%. I come in with $100,000 looking to buy a treasury bill, and I say, Chris, can I buy it from you and get 1.5%? And you say, sure, I'd be happy to sell it to you, but if I only get $100, which is what I paid from you, then I got to go into the market and get only 0.1%. So I'll sell it to you, but for $102 so that I make the 1.5 plus 2%. And so I made 3.5 or 4%. And that's what happened last year. That's how bonds were up 6%. But now, as I said, rates have come down so low that it's hard for rates to come down even more. And as a matter of fact, rates have gone back up a little bit in the last couple of weeks. So at some point, people will say, I can get 2% on a bond. I'm not going to take the risk of the market because now there is an alternative that's relatively appealing. And that's when the market will sell off, because that's when interest rates will go higher. You'll pay a lower multiple and the market will sell off. When that happens, I'm not so sure. Other things that'll affect it, the multiple, are if corporate tax rates go back up. One reason the multiple went down, one reason the multiple went up was because corporate tax rates came down, so companies were able to make more profit. And that happened 3 years ago. And now the issue is more, will corporate tax rates go up and will personal tax rates go up and so on, some other issues there. So, but because bond rates are so low, we still prefer stocks to bonds, but believe in the diversification of bonds, even though I don't expect much return, that there will be a good balance. And so your portfolios are 40% stocks and 60% bonds. And for this year, we have new systems, so we're able to close the numbers and the performance sooner, but we're not, normally we'd get it done on the 20th of the month, give or take. Now we're on the 7th of the month. So the numbers haven't been scrubbed that much, but we're able to show annual numbers. And it looks like we were up about 10.7% last year for the year. And another point I'd make is, ironically, starting in January, we were actually up and hitting new highs up until February 19. And then you've all heard the story about February 19 to March 23rd, we were down 34% in 14 business days, I think it was. So the first quarter, January 1 to March 31st, we were down 6.9%. The equities were down 20%. The second quarter from April 1, and I'm now looking at page 1 of 19 in the package. This shows the quarterly and annual performance. So I'm looking at the 10.7% number for the year 2020. And going back to the down 6.9%, which is January 1 to March 31. So that's the first quarter when the equities were down 20. So obviously bonds were up in that period and provided a nice balance. Bonds were up a decent amount because rates were coming down because we had this recession / depression. And then in the second quarter, we were up 8.7. Now the market was up 20%. So it went down 20% in the first quarter, went up 20% in the second quarter for the half year, because the way math works, when you're 20% down from 100, you're down to 80, 20% up from 80, you're only 96. So you were down 20, up 20, and down 4 for the first half. We were down 6.9, up 8.7. And then we were up 3.9 in the third quarter, and then 5.2 in the fourth quarter, bringing us to 10.7% for the year. And you can see how we did past years. In 2018, we were down 1.9%, and that was with stocks being down 4.4%. So again, we had a cushion from being in fixed income in 2018. And in 2019, as I said, stocks were up 31%. We were only up 14.6 because bonds were flat and 60% of the portfolio is in bonds. So anyways, and the quarter to date numbers on the bottom left. So this is just October 1 to December 31. We made 96,360 of realized and unrealized gains or losses, which is 5.2% of the portfolio. So the next couple of pages show you the asset allocation. Do you have any questions on the performance? I'll show it again later on for the quarter and for the year to date. So page 2 of 19 shows the asset allocation. 8% cash. And one thing I was going to mention, on the cash, we're actually a little light on fixed income because we sold like a Boeing bond a few months ago because we're a little uncomfortable, even though it wasn't a big bond size-wise. But there was a time where there was some concern about the outlook for the airline industry and obviously for Boeing. And we sold it at above par, so it was doing quite well still. So, but we kept that in cash, and then we had another bond that matured a few weeks ago that we kept in cash, hoping the rates would go back up a little bit so that we could get a little bit better yield on the new bonds. And so we're actually 8% cash. We were at year end, and that'll probably come down below 5 as soon as we find a bond that we find relatively attractive or two. And you see large cap of 37%, international 6%. So overall, we're 46.5%. No, 43% equities, 44% equities, and if you go to the target allocation on the next page, page 3 of 19, you see the allocation, 8% cash versus 1%. So we're 7% overweight cash. And we'll take a little bit of that into fixed income. We're underweight fixed income because we're overweight cash. And within the ranges for all of them though. And then equities in a range of 30 to 50. We're 6.2% overweight in equities at 44.2. Okay. And that's at the high end of the range. The range for equities is 20 to 45, and we're at 44. And one thing we wanted to talk a little bit about too is getting an updated IPS that we've been looking for a while. So, but we can discuss that if you like. Looking at, this is for the allocation of the portfolio in more detail than the asset allocation page before. In terms of strategy, as you probably can tell, I'm probably going to stay overweight equity and stay underweight fixed income for the time being, unless, you know, as I said, unless rates go higher or inflation looks worse or government debt goes up and rates go higher. And or if rates go back up, then at some point bonds will be appealing. And so I'll move some either from equity or from cash into bonds. You can see the breakdown. The JP Morgan bond is the largest bond we have. So remember, when you see these coupons on these bonds on page 4 of 19, the actual yield to maturity is lower. Like you can't go get, do the first one, Arizona Public Service, 3.35% coupon. You'd have to pay $104, $105 for that to get back 100, because a 3-year current one that you pay 100 for is paying probably 0.7% or so on a 3-year bond. And that's the case right across the board for all the bonds. They're all at premiums. The US large cap blend, we have a strategy that we've been doing for 14 years that I'll show you a highlight. We're very proud of the performance. It's outperformed with less standard deviation or less risk. And so on page 5, you can see the individual holdings alphabetically with their allocation.
Do you know who selects these stocks as is this you who's making these decisions as a portfolio manager, or is this someone else that we're participating?
It is, we have analysts and a strategy group and portfolio, and I'm a portfolio manager. I was a portfolio manager at MFS for 17 years, ran a total return fund and a mid-cap value fund. As I tell people, I had 9 million investors and I never met one of them. Now I have 100+ investors and I talk to them, as often as they want. So we have, it's all internal. Well, I mean, we get research from the street and so on, but our analysts, and what we do is, and maybe this is a good time to just turn to page, what would be page 15 of 19. So when it says Source Morningstar Direct on the bottom.
Got it.
And if you look at the top right here, so this is January 1 of 06 to September 30 of 2020. This is about 65 large cap stocks. The return, and remember, most large cap funds underperform the S&P, so we outperformed the S&P 10.76 versus 9.21 over that 14-year period. Standard deviation is the volatility or the risk. We were lower is better. We were 14.15 versus the S&P at just about 15. So what that generates, having higher return with lower volatility, is alpha, which is unique outperformance of 1.81% per year. And the beta is similar to less standard deviation, less volatility at 0.93 versus 1 for the S&P. The combination of return per unit of risk is what's called a Sharpe ratio. Higher is better, more return per unit of risk. It's like return over standard deviation, basically. And so we're 6.66 versus 0.53. Looking next, we don't outperform over time. We haven't outperformed in up markets. If the market's up 10%, we're up 99.42% of that on average, or 9.94 versus 10%. So we perform almost equal to the benchmark in up markets. But in down markets, if the market's down 10%, we're only down 9.066. So we make it up in down markets. Has afforded us the ability to outpace the S&P. And if you look in the middle where it says trailing returns, ours is a large cap strategy. You can see this below it is the S&P 500. So comparing to the S&P 500 or plus or minus the benchmark being in this case the S&P 500. We've beaten it over every period: 3, 6, year to day, 1 year, 3 year, 5 year, 10 year. The large cap strategy versus mutual funds in that area, the Lipper large cap core mutual fund category, we've beaten, that's underperformed the S&P. So obviously we've outperformed the large cap category more than we've outperformed the S&P at 2.3, 4.1, 6.66, 6.56 1 year, 4.94 per year for 3 years, 3.77 for 5 years, and 10 years, 2.84. And again, at the bottom there in the middle where it says trailing standard deviations, this just shows that our standard deviation or risk is lower than the S&P 500, which I showed you in the top right, but now it shows it to you over 6 months, 1 year, 3 years, 5 years, and 10 years. And then in the bottom right, it shows we don't make big sector bets. We're more than 100 basis points overweight discretionary, healthcare and technology, and we're more than 100 basis points underweight energy and financials. And then this is for the third quarter of 2020. We don't have the fourth quarter. We have the numbers up, but we don't have this chart, this fact sheet. We're 61 names versus 500. We're large cap for $500 billion average market cap. operating margin. So what we do, to get back to your question, is we use Ned Davis research to screen like the whole S&P for us, screening on the metrics that we put together, like return on invested capital and free cash flow and PE multiples and earning estimate reversions and so on.
Yeah.
No, earnings estimate revisions up. And we get a list from them, and then our analysts and so on go through the individual companies that are 1 rated, and then we make trades. Tend to buy a new position in 2 tranches, buy half of a position, and then wait a couple weeks and see if we feel good about it. Like we bought some United Airlines, and then rather than finish the purchase, we sold it. And then when we sell, we tend to sell in 2 tranches as well. And then we'll replace 4s and 5s that are lowly rated with 1s and 2s. So we use them for the screening, and then we do the undercover work, I guess. And then you can see on the bottom left, for the 3rd quarter, these were our contributors: UPS, NVIDIA, which is a chip company; Thermo Fisher, which is the old Thermo Electron, and Fisher Scientific out of Hampton; Nike, obviously, and Target. And then the ones that were detractors from performance, that's just for the quarter, and so on. So that's kind of a overview of the large cap strategy. And then in the other categories, we'll buy exchange traded funds or index funds if we don't think active managers can outperform their benchmark. If we do think that active managers can outperform their benchmark, and we find an active manager, let's say in small cap value or small cap international, you have to be comfortable that they'll be able to beat their benchmark by more than their incremental management fee on an active mutual fund manager. So you can see the allocation of the portfolio going back to page 5, 6, and 7. Bottom of page 7 is a good example of that TS&W International Equity Portfolio. That's international small cap value funds. They've been doing it for decades. It's Thompson, Walmsley, and Siegel. Thompson, Siegel, and Walmsley. And they're out of Richmond, Virginia. So we'll do a call with them maybe, once or twice a year, and then we'll get an update. We had a different international fund that they made a bet on auto parts and semiconductors in Europe, and we weren't comfortable with that. So we, in essence, dropped the fund manager and bought a different fund. So on page 8, this is the portfolio detail based on return of the individual names. For the 3-month period ending December 31, the portfolio started October 1 at 1840, 695, ended December 31 at 1,934,647, or was up 5.2%. That's versus a Newmarket policy, which is a 40-60 or 60-40 fixed income equity portfolio, which was up 5.7%. So we underperformed a little bit because our fixed income position, because we thought rates were going to go up, we were short what's called maturity or duration. So because rates came down, as I mentioned earlier, instead of making 1.5%, bonds that were longer in duration made 5% because rates came down. So they had a piece of paper that was going to pay them 1.5% for 5 years. Instead of maybe we owned a piece of paper that was going to pay 1.5% for only 2 years. So when rates came down to 1% or 0.5%, the 5-year piece of paper was better than the 2-year piece of paper. When the opposite is true, when rates go up, being short duration like we are, we should do better than the bonds that have longer duration, because now rates have gone up. So I can go to the market instead of having to hold something at a lower rate for 5 more years. I can go to the market and get something at a higher rate for 2 years. So as a result, our fixed income taxable was up 0.2 versus the Barclays aggregate bond index up 0.7. You can see how the individual bonds did. And then the stocks on the bottom of page 8, where we're up 11.6. Now that's in a 3-month period versus the S&P, and this is the fourth quarter of the year, up 12.1. So the fourth quarter, after a very strong second quarter, was actually quite strong as well. Again, driven by liquidity and so on. And the reopening led to some earnings that were surprisingly better than expected. So you can see some of the moves even for just a 3-month period, where Applied Materials was up 45.5%. Apple was up, how much was Apple up?
14.
15, yeah, 14.8.
Right, yeah.
Gotta get a different color on these lines to make them visible.
Mhm.
Like Chris, you'll need your third pair of glasses to read it. And so on. Intel was down 10%, so that was an underperformer. And so on. And then it continues on the next page. The banks did well in the fourth quarter, so PNC Financial was up 37. And then you see on the bottom of the page, international developed equities, we were up 16.5% in that 3-month period. Remember, 16.5, that's annualizing at 70% or so, compounded.
Quite strong.
Yeah, it was very strong. You know,
So you got a good group there, though.
yeah, thanks. And then, so we beat the international developed 16.5 versus 16.1. And you can see that the one I mentioned, there's some international stocks there that we treat as US stocks, but they happen to be listed. You know, Accenture, for example, insurance companies out of Bermuda. But that TS&W International Equity Portfolio, that's the one I mentioned. It's out of Richmond, Virginia. Going to page 11, this shows for the year. Portfolio was up, started the year 1,765,000, had a gain of 187,000 or 10.6%, versus the benchmark policy. We were up 10.6. The benchmark policy was up 12.6, and this again was basically from having a little cash that hurt eventually for the year, but it added some stability in the performance as well. So, and in this period, the large cap strategy, the stocks outperformed pretty well. The fixed income was up 6.4 versus 5.5 for the Barclays Ag. The U.S. large cap equities on page 2 of page 12. You can see we were up 20.7% for the year. The S&P was up 18.4. You can see names like Apple up 72.9%. That's a $2 trillion company. When I mentioned being an analyst on it, and when I was an analyst on it, John Scully was there, not Steve Jobs. He was a marketing person from PepsiCo. They came in to take over Apple, and they had no operating earnings. They'd gotten a check from IBM and Microsoft because of antitrust issues. They wanted to keep Apple in business to provide something besides the PC for the student market and the graphic design and some other markets. So Apple checked from them for $260 million, which was a lot of money back then. It's not today, I guess, but their only earnings were interest, and interest rates weren't zero back then. They were 4 or 5%. So their interest income was a sole source of earnings. On an operating basis, like selling styluses and so on, they made no profit. So And that kept them in business until Scully got kicked out, and now it's gone from basically $1 billion company to a two-plus trillion dollar company, and people have targets that it's going to double again to a $4 trillion company, which is bigger than the whole U.S. was probably a couple of decades ago.
It's insane.
So, yeah, it really is. But it's all in a multiple. Their earnings actually haven't grown very much at all. But they went from, like I said, 12 times earnings to 33 times earnings.
Right.
And now, if the economy, comes back, and well, we'll see. The issue with them is more, and now it's the antitrust issues again, and regulation, and so on. So you see, some of the weak ones were like Boeing. It's actually, that one's not measured correctly, down 48%, because if you look at number 2, means we sold it during the period. As you can see, the value is 0. We sold that, and we sold CBS during the period. So that's just measuring the performance while we owned it. So you wouldn't compare that to the S&P or anything that was owned for the whole period. The ones with
I see.
the ones that don't have a 0 in the second column from the right, that don't have a 0, are positions that we had for the whole quarter. So you can see, you got Apple is actually the biggest performer. Amazon was pretty good too, up 62.1%. Intel we sold. Well, we owned it. It was down 25%. I mean, even though our performance has been good overall versus the benchmarks, very good. We have some dogs.
NVIDIA is scary good. I'd love to understand what's going on with that company.
We had a colleague who recommended that to us a couple of years ago, and he runs our trading side and our portfolio management group. And he kept talking about it. So we finally bought it. And then at one point we sold it, and then we bought it back. And it's just been a great stock. But there's so many video games and other things where the chips go into and stuff. That's why you look at Intel's performance versus NVIDIA's, and they've just blown them away. So
Target too. God, Target's doing phenomenally well in terms
Yep.
of percentage gains.
Yes, and that's because it was, going as the retailers were getting in trouble, the Macy's of the world and so on. People expected the same for Target, and once they stabilize, and it's it's a more moderate price point, so that whether stimulus money and other things and stuff, so they've done actually a lot better. And the balance sheet isn't as leveraged. So, but yeah, I was surprised because you've had several retailers, obviously they've gone out of business and so on. So then you see even a Thermo Fisher Scientific at the bottom of page 13, up 50%. PayPal Holdings is up 105%.
Yeah, that's not surprising. Why are we holding on to Waste Management? Ideas?
I don't disagree with you. So, I mean, it's not a full position anymore. So, but if anything, it'll probably be more highly regulated going forward. So, and with the green president, we'll be spending trillions of dollars to reduce plastic and waste, and putting Waste Management out of business. So, yeah, I haven't asked about that for months. I'm going to put a note down here. Management.
What's the other one there? Verizon's not looking too great either. I'm a little surprised by that performance. although it's a small position. It's another one.
Yeah. AT&T's the one that we haven't played. We've been out of that for a while. We've been in Verizon for a bit. Zoetis is a dog veterinarian company. And then we went over the large cap strategy. And then the 16 of 19 is the fixed income characteristics. And you can see if you go to the coupon rate, my mom's calling me. She's 94. I wonder what she wants. So if you look at the coupon rates, I mean, they all look juicy, right? 3.4, 3.3, 2.4, 3.9, or whatever. But you gotta, and I've shown this in the past, that's like 54. It's ending value was 54,152. But when this matures in June of 2024, you're only going to get 50,000 back. So you're going to lose almost eight points over that 4-year period. So you're going to get a coupon of 3.4 for 4 years, and well, actually 3 years now. So you're going to make 3 times 3.5, which is 10.5% interest. But you're going to pay 54 and only get 50 back, so you're going to lose 8 of principal. So what adjusts for those two, the coupon plus the loss, the coupon interest income plus the price loss, because these, as you can tell, are all premium bonds, are the yield to maturity, which is more or less the treasury curve, is like 0.9%. So that's all. When you net out the 3.4% you're going to get for 3 years against the premium of $4,152, you're going to lose. Your return is going to be a yield to maturity of 0.9%, which is in line. And as you can tell, when you look at the modified duration number, that's how long it's out there. A little bit longer is a little bit higher yield to maturity. So the first one's 0.9, they average 0.4. You can see the black at the bottom. So the 0.9 is above that because it has 3.3 years of duration, where the whole group is only 2.6 on average. The one that's 0.8, a few numbers down from there, that one is a coupon of 3.9%, but there you're paying $6,802 you're going to lose between now and 2025. So all you're going to make is 0.8% yield to maturity. Now the ones that are shorter in duration and AAA, like the U.S. Treasury note of 2021, the Treasury note, the short Treasury note has a yield to maturity of 0.1%, and this duration is only 0.7. So that's all you're going to make on that one is 0.1%, and the same with the other Treasury notes. So if I went out today and bought like a 2-year Treasury note, well, I just talked about it. It'll be 11 or 12 basis points. And the Fed's going to keep that short end of the curve. That's what they can control and keep it down close to 0. And they've said they'll do it for a long, long time. And, you know, they might have to change if, like I said, the dollar gets really weak and we're not able to refinance our debt. We'll have to wait and see. But I don't want you to think that, God, you know, why don't you go buy a 3.3% Bristol Myers coupon, because in practice it's only worth points. I'm only gonna make 0.3%, and that's the reason you only get 0.1% on a money market account at the bank now, because there's more risk in a Bristol Myers bond So you're gonna get more than the treasury, but you're only gonna get 0.3 because that's what the treasury market is offering, is only 0.1.
I mean, under normal conditions, this would look like a really good mix of bonds, but just the craziness of where we are these days.
Yep, and remember, they're all premium prices, you know? Like that first one, instead of it being priced at 108, which is, 54, it's based on 100. Instead of it being priced at 108, if it was priced at 94 and your coupon 3.4, then you're going to get over 3 years, you're going to get 10.5, 11% interest, and then you're going to make $6,000 on it. So you'll make another 2-3%. So you'll make 13. So your yield to maturity will be 11 plus 2 or 3. So 13 divided by 3 years will be like 3%. Well, actually over 3.5, because you're paying less than par for it, and you're going to get par. So you'll get the coupon plus more, because rates in the market have gone up quite a bit. So, and that's why I'm not sure where that fulcrum is, where that trigger is. Is it, we're at 1% on the 10-year today. Is it a 2% on the 10-year where people say, you know what, I'm going to take some money and go park it in the treasury, or tax exempt, maybe Biden gives more money to states and local governments, hopefully in your case and for a lot of our other clients, that, maybe munis might be more attractive and so on. But in general, they are crazy times in terms of rates being unattractive. And the government's done that since 2009. It basically penalized the person who was on fixed income and had to couldn't afford to go into the market in a big way. And so they stayed in short liquid investments like cash. And early on, they were getting 3 or 4%. And then that just came down to zero as the market was going up, as I said, 14% a year. And so you had a dislocation between wealth and not its wealth for the elderly, which, like you say, you can't earn it back. So, but that was public policy, and Powell carried it out. Yellen carried it out first, and then Powell followed on. Page 17. Oh, so I want to say too, on the bond portfolio, you can see the average rate on the right. So obviously we have a safe bond portfolio, A or better, right across the board.
Yep.
And then page 17, this is, we get more of the data. We switched over our data on February 1 from, we used to have SEI compliance services to Black Diamond and Intertrust. And so we cut off all the old data as of July 31, but started measuring the new data as of February 1 with the new company. So the historical numbers, we have to go back and reload 15 years of data. And, I don't know when we'll get around to that. But as a result, that's why the different lines are blank. So.
Okay.
So for the quarter to date, we just talked about it, 5.2, year to date 10.6, and you see the cash return to fixed income in the portfolio versus the Barclays Ag, then the large cap equities versus the S&P 500, and then the international developed versus the EFA. And then there's a couple of pages of disclosure and so on. And I'm open to any questions or anything else. So we would appreciate, a new IPS down the road. We can look into using one of our tablets, but if you have one that you're,
Bonds.
well, each country is different and so on. So, but, the Treasury prints the money and the Fed borrows it. And so the Fed's investments have to be reasonable, you know what I mean? So they can pay back the treasury. But they do different things. I mean, at times markets lock up. We had last year on October 15th when corporate tax payments were due. What's called the overnight market. It's a repurchase market, repurchase agreements. It's called repos. There wasn't enough money up there because all the corporations that bought paid their quarterly taxes. So for the night, the market froze like the preferred market froze in 2009. And so for overnight, this very safe, you've got collateral of overnight treasuries. It went from like 10 basis points to like 9% because the main dealers had moved away from the Bear Stearns and the Lehman Brothers, but now with the 4 major banks. So then the next day, all the traders tried to pick off the repo market again. And so then the Fed, the third day, came in with a backup line of credit to the repo market, and then rates went back down to 1%. So there's no fast rule to where they can invest necessarily, because you could have said that about the credit default swap market in 2009 when AIG had trillions of dollars of exposure. But by and large, you know, the purchase plan, with quantitative easing, which we're on quantitative easing 20 now or whatever, we're still buying securities. So the securities they buy, they tend every now and then they'll buy in the mortgage-backed market where they didn't used to buy. They used to just buy credit, treasuries and so on. If you remember back in March, that was a big move when they didn't end up putting much money out, but they said they'd buy high yield and they'd buy corporate debt, which they hadn't done before. So I would argue then, you know, they get their wrist slapped a little bit from Treasury because the Fed Reserve's going out and buying high yield and so on. But Mnuchin was like, yeah, go ahead and, you know, stabilize these markets, go buy junk bonds, go buy whatever. So, and just the announcement that they were going to do it, obviously people front run, and so the prices went up, so they didn't end up having to do it. But they're an active player. Governments in general are active players, and it'll be interesting over the next 10 years to see how China and the yuan and so on, their currency plays out, and what happens to some of our behaviors aren't very good as a country. And you know, we've been a democracy for hundreds of years that you hate to, you know, lose it now.
That was a comprehensive way to go through it the way you did. Thank you.
Well, thank you. Appreciate it. I love to talk about this stuff, obviously.
Is there a point at which we should be talking to you about any possible changes to the portfolio, or in the next few months?
Well, I will say, you know, we have probably 20 towns and municipalities, and most of them are bifurcated by trust funds and capital reserves.
Mhm.
And so a decent number are 50-50 on the trust funds in terms of asset allocation. And then the cap reserves will be mainly fixed income. Some use capital reserves and put a small equity component too, because, you know, if they don't really need the funds and they have the visibility that they won't need it for a few years, you make some longer term investments. And then a lot of them are 50-50, 50 equity, 50 fixed income. And then a decent number, I'd say more than the 40-60, more than that, or 60-40, 60 equity and 40 fixed income. And then I have one town that has 80-20 for part of their portfolio because they don't think they'll need it for a long time and they want to benefit from growth. And obviously it's been the right place to be. So from your perspective, the 40-60, I think, is the right mix. That you have most of the funds in there. So I think that's good. And then the question just becomes, at some point, I have freedom to go between 30 and 50 on the equity side and 50 and 70 basically on the fixed income side. So there is some flexibility that if I really do think that equities are crazy valued and that, there's signs of things falling apart, that I can cut the equity portfolio down by, 5 or 10 percentage points. But in terms of, if rates, as I said, were 4 or 5%, then I'd say let's go 20%. And equities were at this level, I'd say let's go. Multiple would have to come down on equities, and you can't time it exactly, but I would say let's go to 20% equities instead of 40 and 80% fixed income. And similarly, as rates go down to zero, and we think they're going to stay down to zero, that I would buy more equities, unless the reason rates are at zero is because we think we're going into a depression. And right now, as this vaccine plays out, we'll probably recover quite strongly. And it's just a question of, is it Q1 this quarter, next quarter, or and this is the wild card, is we get new strands that we've had and so on, new strains, that we go into a depression in the second or third quarter, and Biden, currency is out of favor, and we have too much debt, and interest rates going higher. Our dollar gets weaker, so our inflation goes up, and Biden's got to raise taxes in that scenario, which will stifle the economy even more. So that's the reason even though I don't like bonds where the yields were a couple of weeks ago, at basically zero, we still had 50% of the portfolio in there. And it did us well in the first quarter of this year. It held us back a little in the second quarter, but it let us sleep nights.
Okay. Well, thank you very much.
Thank you. Looks like you got a room at a bed and breakfast.
Yes, that's what it's like. If the trustees could hang in there for a few more minutes, I just want to cover a couple of things. And I'd like to get you guys to make at least one decision. And then, and the bankers can have a nice evening.
Wonderful. Nice to see
Really
you
appreciate
all.
the time. Thank you
Stay
very
safe,
much.
stay well.
Nice to meet you, Lori. Nice to put your name and face together, Dino. Thank you.
Nice to see you.
Oh, you as well. Have a good evening.
Good
Thank you.
presentation.
Bye now.
Good night.
Good night.
Okay, so I mentioned earlier, and I couldn't remember if you were already on, Charlie, or not, but I made a mistake, or I don't want to say it that way. I forgot that we hadn't gotten Chris on the signer as part of the signature page. So we have to redo all of that when a new signer comes on. It's a kind of a weird quirk of the bank, but essentially anytime you change a signer, all signers have to change on the signature sheet. So I know it's, anyway, it's the way it is. So we were talking about, I have the forms ready, and they'll be with Wendy Chase in her area tomorrow in the morning. So if you came by anytime after 9, they'd be there for you until noon, because they're usually she's done at noon.
Yeah.
If that doesn't work for you, then Monday is fine. And there's a couple of things. Now, in your case, Charlie, I wrote the letter as if you were the representatives of the trustees as the signer for the letter that says, here, Chris is going to be coming on as a new trustee.
Okay.
Here's her documentation. Because when it comes to those kind of things, it can't be from me, because I'm not a trustee. I just, do things on your behalf.
Yep.
So I was gonna bother Colin with it, and I thought, I know that Colin's got some time restrictions, so because of work, so I chose to put your name on it instead, Charlie.
Well, I got work involved too, but I'll make it work out.
Okay,
I'll
thank
get
you.
there.
I appreciate it.
I've actually gone back to work in 2 different towns.
Oh, is that right?
Oh, wow.
Here, I thought you were taking a break permanently.
I thought I was too.
So then the other thing is for you guys to decide, conduct whatever your business. I can get off the line if you want, then the 3 of you can talk. But the one thing that really is important is for that one of you, that you decide that at least one of you gets trained to be the person to move funds once deposits get made or withdrawals. So for example, we're going to be, the check that Chris signed today was for 690,000, I believe it was. And so that money will be moved from the sub accounts to the master account, and then it will go out from there. So whenever that occurs, those sub account transactions have to be made, and that's, somebody has to do that. I can't at this point.
Well, with me, once May hits, I'm not in town until late October.
Okay.
Um,
Okay, well, is that something Chris or Colin is interested in doing?
Colin's on mute.
Oh, Colin, you're on mute.
There you go.
Yep. Thank you.
There we go.
Noticed that. I can. My only restraints are I work in Portsmouth.
Yeah.
I work for an HVAC company, and we have been totally busy since last May.
All right. Right.
Biggest year of the company's existence, and the company's been around since '85. So go figure that out. But I don't mind doing that type of thing. I can also use my connection with Terry, I think, to an advantage as well. As much as that can be done, I know throughout this whole pandemic that she's a neighbor of mine, for Chris and Charlie's, just for information for you, Chris. Terry is a neighbor of mine, so what she's been doing is bringing stuff by for me to sign and return, and so that's how we've been doing that throughout the pandemic, because sometimes it's easier for her to just bring it home, bring it back.
Yeah, that's worked well.
Yeah, so it's really the call of everyone. I don't mind doing it, but that's something that that we can decide between the 3 of us.
I will say this, that once you're trained, it's a relatively easy process in that anytime that the transactions need to be made, I will send whoever is chosen, the documentation to show where each of the accounts and the amounts of money that needs to be transferred. So it's not a terribly complex process, but it's a timely thing. We need to make sure that it's done on a fairly timely basis.
And as long as it can be done, obviously remotely from here,
Right.
There's not an issue with that at all.
Yep, and you can log in as long as you have internet access. You're good to go.
Yeah.
Chris, were you going to say something?
No, I was just going to say that that's good, Colin. Go ahead. I was going to say I have my private tutor right here in house. If that wasn't going to be convenient for somebody else, I could step in with the caveat that I have the private tutor, we'll call him in this case. But Colin, it sounds easy for you too. So
yeah.
Okay.
Go ahead there, Colin.
No, I was just agreeing.
All right, great. All right. I don't know if there's any other business that you need to cover. I just know that I think the requirement is that you meet publicly quarterly. And
That was my next question is, do we need a public meeting? And if so, could we pick the date now? Or when was the last one that you did? Or when's the next one due?
Yeah, the last one we did was, oh God. It was way before the start of the pandemic. It may have been the end of 2019. We didn't meet at all in 2020,
Oh, that's not good.
unless my memory has failed to the point where I don't even remember that.
Well, you must have, because Scott met sometime. Maybe not.
yeah, I do remember, I mean, the last time when we did this meeting with Dino last year, the only person who attended, I think, was the gentleman who's no longer who's no longer a trustee.
Right.
And then we all met as a group, if I recall, after that, I think.
I may not have been able to make that. I seriously don't remember anything last year at all about meeting at all. That's what I mean. So it has been a long time.
Yeah.
So setting something up quarterly is obviously to me is the best, even if it's a short meeting, even if it's just you'll cover a couple things. It's obviously well worth. And I don't know what is the requirement, if there is any.
Oh, it's just that you cover, the normal duties of business, if there really is much to talk about. To be honest, I mean, some of these things, it's more like, it's kind of like the budget committee. The budget committee can be a really beneficial thing, but it can also be just another check on the check. And so, in you guys' case, it's really just making sure that we're getting our reporting requirements done. The scholarship funds, that would be a good topic of discussion. Making sure that we're on track with getting things out to students and receiving things back from them. Other than that, it kind of manages itself, with the exception of reporting to the Attorney General through the MS9 and MS10. And I work with the bank on that every year. So, and then you guys, I've done the report already that's going to go for you guys, that goes into the town report. And the only thing I had, and I'm not remembering off the top of my head, but there was one area that I'm gonna triple check because it was a negative, and I think in terms of earnings, and I think it had to do with the fact that it was we took a lot of money out of capital reserve this year. So anyway.
Well, if we met February, May, August, and November, that would punctuate the year nicely. And that would allow that May is likely to be the time of talking about the scholarships, or August would be the follow-up if the students needed any other help, or if they had changed their plans and weren't going to a certain institution or whatnot. That would also allow if there was a wrap-up in February before somebody did or didn't run again or serve again, like in the overall picture of when would the cycles be changing of who's on the trust fund committee. And then that November allows like the closing out of the annual year, but then meeting in February allows any kind of review after the Dino's presentations. So I would propose we looked at February, May, August, and November.
That sounds fine with me. I'm fine with all 4 of those months. Again, as long as we're able, and who knows how long Zoom is going to continue. But as long as we have meetings that aren't too early in the evening, again, I got home tonight at about 5:35, so I was home 25 minutes before the meeting. So I don't like cutting it close. But I also don't like to be on a meeting until 9 o'clock at night.
Yeah, no kidding. Yep.
So, 6:30 even would make which is a weird time to start a meeting, but 6:30 would even be better than 6. And if you get any time after 7, you're starting to, starting to push people till 9 if a meeting runs long.
The meetings don't need to, I mean, it's up to you, of course,
Right.
but the meetings don't need to be long, sessions. Tonight was different because we're going over the entire portfolio.
Mhm.
But normally it's a relatively, I would imagine, relatively quick thing. You're talking about whatever transactions we've done through a period and any other concern, issues that might arise, things that might be of concern.
Yep.
So.
Yeah, those 4 quarterly meetings that the February, May, August, and November sound fine.
How about the first Thursday? I think that's, I don't know if Charlie or you are calling on other town things. Wednesdays are town council. Wednesdays or Thursdays are, I'm on the Conservation Commission. That's the second Thursday. I don't know if, what other considerations you have for clubs or organizations or favorite TV shows or what else you have going, but.
No, I'm the president of the co-op where I live. And so Wednesdays wouldn't be good for me either. So
Good. So let's axe Wednesdays. How about second Thursday? I'm sorry, Charlie.
Any Thursdays aren't bad for me, and if it's the second one of the month, I'm still good for May. August, I can always come home and, I got internet where I am in the summer, so I can probably get down here and attend the quarterlies anyway, so.
All right, then let's do the second Thursday of February, May, August, and November.
Sounds like.
Tentatively.
Yeah.
you want to set a time for that, Chris?
I liked the 6:30 thought, to tell you the truth. It might be, is that okay?
That's fine with me. Yeah. Even in the busiest of months and the busiest of weeks, I usually walk in the door because I get a text from my wife. Do you remember where you live?
Aw.
It's about time to come home.
Puts you on a
yeah,
beeper.
6:30 would be great.
All right.
So are you guys, you need to choose a chairperson, I believe.
Chris?
I think, Chris, you're kind of acting in that role already.
Oh, it was a mother hen thing, like just.
We're organizing everybody. So that's,
Aye.
Aye.
All right, we'll have Colin do the transfers on the computer. I'll be in this role. And I would say that I was intending on pulling the papers to run again for this since I'm filling out a term that's just a couple of months, but I was interested in pulling the papers. So time will tell about that, what the contention is for running for trustee of the trust fund, but it was my intention to do that anyway. So,
well, that's good.
all right.
All right, then. So at these, this is the first, aside from the other 2 meetings that we assembled, I have really never been participating in these. So it's up to you. If you'd like me to attend these meetings, I'd be more than happy to be here. If not, that's fine as well. The one thing that I want to do is because they need to be public, we'll make sure that we work with Tim Kremen to arrange these so that at least, they're recorded and other people can view them.
I know how to bother Tim. He does I send him a newsletter column for the Newmarket e-news. So
Oh,
I
great.
know how to bother him good.
Very good.
Right, Tim? All right.
Bless
All
you.
right.
One more question. You referred to training for the transfer of those funds. What and where and how? I guess not why. I guess I know why.
So we'll need to get in touch with, I can't remember, I believe that Lori will work with us.
Okay.
And then there's another person who's on the government side who deals with helping getting that training accomplished. And then we'll need to get you access. So I'll contact them tomorrow or Monday.
All right.
And then
the email address that you have for me is probably the best way to get in touch with me.
Okay, great.
To, on any day, given day. Charlie, I haven't seen you in a long time.
It's been quite a while.
It has. How are you?
Yeah, not bad. You?
Not bad. Still working, but Shirley's.
Well, I've been retired for 10 years and I'm still working.
Yeah, Shirley's been retired for probably about 7 now. So
yeah,
and I probably have another 7 to go before I retire. So
I get different towns keep calling me back to work to help them out.
Yeah.
So
What do you do, Charlie?
I'm a retired building inspector.
Oh, that's why you're working with the different towns. I get it. Yep.
Well, there's definitely worse things than being called back by people who like the work you did before. So,
Well, yeah, because I spent 22 years in Newmarket's politics a long time ago too. Colin probably the only one that remembers.
yeah. Yep. Just on a side note, Eddie Peltzer was part of this for a long time, wasn't he?
yes, he was. Yeah.
And that was a sad obituary to read today. Good man. Just a good person.
Right.
Did things right, but I think he's passed on those same traits to his son Michael. So, God rest his soul. But it's sad to see both he and Helen go within the same 12-month period.
Oh wow, yeah.
Yeah. So just want to mention that because I knew Eddie had been on the trustee of the trust fund for a number of years. Yeah. So not to end the meeting on a downer, but just to give him a little bit of recognition because of what he gave to Newmarket.
Absolutely.
Yeah.
Okay,
All right, so
Chairperson. I'm gonna give the reins on to you, and you can take charge of this meeting from here on. And
I think take charge is probably about 15 seconds worth of go enjoy your dinner or your snack or your TV show or whatever it is you do now that you can just go be cozy and know you've done something good today too.
or all of the above.
So now
All of the above.
I can just serve as tiebreaker. Right?
Yes.
right.
Yeah, there you go.
Good function.
So
All right, well, thank you.
sure.
All right. So, just send me an email. Give me the contacts of who I need to contact to set up the training, and then I'll take it from there, and I'll keep you posted on what's going on with it.
Okay, very good.
Yep.
Excellent.
All right, not a problem at all.
Good night.
All right,
I'll
guys.
send these dates to
Have a good
Tim.
evening.
So
All right, terrific. Thank you, Chris.
Live long and
Okay.
prosper.
bye now. Nice to meet you.
Nice to meet you. And thanks, Tim.